and we add the formula uh, sales multiplied by the percentage that we actually have. So we will actually come up with our cost of goods sold. So this is our basically a number for cost of goods sold. um, let's actually eliminate this decimal place, and the same formula will apply to all of the other income statement items, but before that we will actually need to fix this and apply this to all of the other data. So as you may see right now, we have all the items that we need for the income statement. So, and at the end we come up with the net income. But we need to note that there are some expenses that are actually fixed in their nature. So we actually are required to make some corrections in this common size financial statement for 2000. So this is basically that we are told by our accounting team, for example, that some accounting expert that our fixed expenses will stay as it is. So let's say it's also going to be 10,000, 100,000, excuse me, for year 2005, and our depreciation expense will also stay the same as 20,000. Now that we have these changes made, we need to actually make a correction to our data, meaning that, for example, we have made inputs from here, but we need to make corrections in here because there should be a formula in this place. So we actually deduct the sales. From sales we deduct the cost of goods sold, and we come up with a gross profit margin. Let's ignore this, and then we have additional expenses in here, and again for EBIT we need to make a input as in this formula, so we just copy it from here, and the same thing for our earnings before taxes, and for tax income, of course, we need to use the actual data that we have got from here, multiplied by the 40%. And again, we need to make correction here as well. So this is actually the net figure that we have. So again, let's go through it. We have the sales information that our sales will be in 2005 will be 4,300,000. Based on that, we can actually calculate the percentages based on the information from 2003 and 4. So we come up with the average, for example, average for cost of goods sold and other items. Using these average percentages, we actually calculate our cost of goods sold by multiplying our sales by the cost of goods sold ratio, and we just leave this formula for our gross margin and other items like earnings before interest and tax, earnings before taxes, because this actually this data, this information depends on how the previous information on it builds up, meaning that if we have these items sales and cost of goods sold, profit margin should be their difference. So that's how we actually again copied from the 2004 data, it's the same formula. We make additions based on the same data as a percentage using our sales data, and this for this ones we don't use the percentages because this is the let's say predetermined information that we also know for 2005, so we are actually more sure on that. That's why we don't use the average percentage for that. And again, we use formula to calculate earnings before interest and tax, which is again the difference between gross margin and the selling, fixed, and depreciation expenses. And then we have the interest expense that we calculate from the same formula, and then again using the same formula we deduct earnings before interest and taxes, the interest expense. And for tax we use not the percentage, but we use again the earnings before taxes figure. So as you may see, it's taken from here and multiplied by the 40%. And net income is actually the difference between two of them, which is you may see in the formula as well. So now what does this mean? This means that if there will be sales of 4,300,000, and if the percentages of the ratio between sales and other figures such as cost of goods sold, selling and G&A expense and the others will stay the same. This means for 2005 we will have approximately 92,697 dollars net income. And below we just add a note that percentages calculated on 2004 are not based on the actual estimates, but this is based on historical data that we have from 2003 and 2005 2003 and 2004. So, and that's how we put it in our notes, so that whenever the other people and the accountants in your firm would like to see this your common size income statement, they will know where this number is coming from. Another thing that might help us to build our common size income statement without any, well, not without any, but with little errors, will be to have these additions regarding each item in the income statement. For example, adding these words like does change with the sales volume, the formula, and does not change with the sales volume helps us to identify other things that actually we need to take from the formula of average sales or not. So, for example, I need to go back again. The cost of goods item, for example. So we know that the cost of goods really changed with the sales volume. So that's why we took this number from the average percentage of sales from the previous data. But for the items that does not change with the sales volume, we have used actually the data that we actually think will be in 2005, no matter how much sales we'll have. So for example, fixed expenses, depreciation, and interest expense includes in here. That's why we need to make a change in here for interest expense, which is also supposedly going to be the same, because interest expense is something that we pay on our long-term debt. So there's no correlation between the sales and the interest expense payment. As you may see, as we have made all the things in here as a formula, as soon as I made a change in the interest expense item, all the changes reflected in our earnings before taxes, in the tax payment itself, and in net income. So as you may see, I have made a note in here that all of them should be formula, and as you may see, they're all just simple formulas of calculation and deduction. Um, so having these kind of notes nearby your income statement will help you a lot identifying where to put the formula and where to put the actually the numbers which does change with the sales volume. So that's why you need to take the number of the average percentages from the previous data, and where you are sure that this does not change with the sales volume, you just take back the number from previous year, which is, for example, in the example of interest expense, it's 76,000, and we just transfer this same amount because this is not going to change with the sales volume. And for the item that, for example, cost of goods sold, we actually took the average. So as you can see, average of sales data, and we multiply it by our sales figure, and we come up with this cost of goods sold number. And now a couple of words about the ratios that are commonly used in order to analyze the company's performance. And a lot of figures actually depend on income statement figure. So we start with, for example, the most common ratio, which is return on assets. Briefly, it's ROA. And the formula for return of assets is simple as it is. It's net income divided by total assets, and we will use a percentage, so we add just percentage in here. So let's assume that we have, for example, in Elvis' case, we have this balance sheet.